Okay, good morning. My name is Gavin Smith. Thank you for joining me today to have a look at Vodacom. So I'm going to start off with the nature of the business, then I'm going to have a look at the recommendation, the financial review, the divisional review, the company guidance, and lastly, our portfolio guidance. So starting off with the nature of the business. Looking at the product segments, the two main categories here are equipment sales and service revenue. So equipment sales is the revenue generated from the sale of devices, being your handsets, laptops, etc. Service revenue includes voice, a revenue stream that has been declining due to lower average rates per user, which is the long for ARPUs. Data continues to grow strongly. In the South African business, it actually contributes more to service net revenue than the traditional voice. Enterprise, which is predominantly based in South Africa. In this business, the group offers services such as cloud and IoT, which is short for the Internet of Things, a term used for connected devices. Growing the enterprise business is a key part of Vodacom's strategy. Service revenue also consists of M-Pesa. This is a mobile payments platform which is offered in the African territories and is quite a meaningful contributor of revenues in the region. The service isn't offered in South Africa, and this is because the banking system in South Africa is a closed network. Looking on the right-hand side at the geographical split, recently Vodacom acquired an indirect interest in Safaricom through acquiring a stake in Vodafone Kenya. Safaricom is Kenya's leading telecoms provider. The investment is accounted for as an associate, so this means that revenue is not consolidated into Vodacom's results, only its share of profits. However, just to give a clear picture of the group's geographical split, I have included it in this chart. So South Africa remains the group's dominant business, accounting for 72% of revenue. Africa contributes the remaining 28%. 10% from Safaricom and 18% from the other group's other territories. So now moving on to our recommendation. So we do believe that the share is overvalued at current levels. Over the medium term, we are expecting some pressure on earnings growth. This will come from consistent pressure on data prices, weak domestic economy, increasing competitive pressures, and rising capital intensity driven by strong demand for data. On a relative basis, however, the company does look fairly valued. It's trading at a PE ratio that's in line with its historic average. In terms of quality and capacity of the network, Vodacom does have a competitive advantage. However, with a very saturated local market, the group should still experience some pressure on pricing. In terms of their capex budget, they're still investing heavily in their networks, which does position them well to capture growth from the data segment. They do operate in a highly regulated environment. There are proposed regulatory changes that are intended to level the playing field, which obviously benefits the smaller competitors, and this does increase forecasting risk. A big focus for them is big data. Here they're utilizing machine intelligence to learn more about their customers, and this allows them to offer more tailored or customized packages to their clients. Then lastly, the Safaricom acquisition has been dilutive to earnings over the short term. However, we do believe that over the medium term, it should help offset some of the slower growth in the local environment. Now onto the financial review. Just as a note, any numbers marked with an asterisk reflect normalized numbers. So this excludes the effect of exchange rate movements as well as the effects of Safaricom. It gives a better measure of the underlying performance of the business. So group revenue was up by 5% and 7% on a normalized basis. This was largely driven by equipment revenue, which was up by 18% on the back of strong demand for smartphones. Service revenue was a bit more muted, only up 5% in normalized terms. The subscriber base was up strongly by 12%. So the chart here shows the drivers of service revenue. You can see the more traditional revenue streams being mobile, voice, and messaging were detractors, while data and M-Pesa contributed positively to the growth. EBIT was flat. but contracted by 1% on a normalized basis. This is seen in a lower EBIT margin, which contracted by 1.2 percentage points to 25.8%. The margin came under pressure from a higher contribution of equipment sales, which is obviously lower margins, although this was partly offset by higher margins in their international business. Finance costs were 15% higher. Headline earnings came in 6% ahead of the previous period. However, HEPS on a per share basis was only 1% higher, so this reflects the increase in the number of shares as a result of the Safaricom acquisition. The interim dividend was reduced by 1% to 390 cents, and capital expenditure totaled 5.4 billion rand for the 6 months, and this works out to a capital intensity rate at 13% of revenue. Moving on to the divisions, I'm going to start off with South Africa. Revenue was up by 8%. This was driven by equipment and data. Looking at the chart here, you can see that data revenue was up by 15%, with the number of data customers growing by 10%. As I mentioned earlier, data is now the largest contributor to service revenue for South Africa. Equipment sales were 18% higher, while voice revenue declined by 5%. The business saw strong growth in its subscriber base, which was up by 12%. This reflects a 13% increase in the prepaid segment, while postpaid customers only increased by 2%. Their Just For You campaign, which offers more tailored packages, contributed positively to the customer growth. The good customer growth was, however, offset by lower ARPUs, and as I mentioned earlier, that's average rates per users. In the prepaid segment, ARPUs were down by 6.5%, while contract ARPUs were 4% lower. Enterprise grew strongly, increasing by 10% to 6.8 billion. EBIT was down by 2%, and the margin contracted by 2.9 percentage points to 29.2%. This was impacted by higher marketing costs as well as the higher contribution from the lower margin handset sales. Okay, now looking at the international business. Service revenue was up by 6% on a normalized basis. This was underpinned by growth in data, which was up by 7% on the back of a 23% increase in data customers. The charts on the left shows the low smartphone penetration rates in the regions where the group operates. So obviously as this penetration increases, so should data revenue. Looking at the performance by region, in Lesotho, service revenue was up by 10% and the number of subscribers by 1%. In Mozambique, service revenue was quite strong, growing by 16%, and the number of subscribers by 9%. In the DRC, however, service revenue was down by 0.5%. This was due to a challenging economic environment, which was further impacted by the decoupling of the Congolese franc against the US dollar. However, subscriber growth was still strong, up by 24%. Lastly, in Tanzania, service revenue was up 6% and the number of subscribers by 4%. M-Pesa revenue was up strongly by 27% with growth in all markets. EBIT was up by 2% over the period and the margin expanded to 11.5% from 9.2%. The expansion in the margin was due to the combination of cost containment efforts in the previous year to offset slower revenue growth, as well as lower commissions paid on airtime purchases due to the increased uptake of the M-Pesa service. Lastly, onto Safaricom. As I mentioned, this is accounted for as an associate. So just some details on the acquisition. This was done through the issue of Vodacom shares to the value of 43 billion rand, as well as a cash consideration of 51 million. In its maiden 2-month contribution to group profits, the business contributed 349 million rand. And just looking at the underlying performance, the business did perform well. Service revenue was up by 12%, with subscriber base up by 11%. Like the other regions, M-Pesa was a strong contributor, growing by 16%. EBIT increased by 9%. However, excluding once-off adjustments, the business showed strong profit growth of 21%. The company guidance. Data monetization is an important focus area for the business. To achieve this, the company is going to continue to invest heavily in its networks to drive the uptake of 3G and 4G devices. Their strategic priorities include driving growth in the enterprise business across East Africa. This was one of the motivations behind the Safaricom acquisition. Another focus is to continue to focus on big data initiatives, which, as I mentioned earlier, will lead to more personalized client offerings. M-Pesa is also a key growth focus for the company going forward. Just looking at the dividend policy, dividends will be paid out at 90% of adjusted headline earnings, although this will exclude earnings from Safaricom. The medium-term guidance was maintained, and this includes service revenue growth in mid-single digits, EBIT growth in mid to high single digits, and capital intensity between 12% and 14% of revenue. Then lastly, just looking at our portfolio guidance. So Vodacom is a very high quality business, which is seen in its excellent return on equity, high margins, and consistently strong cash generation. However, as I highlighted earlier, we do believe that the share is overvalued, and we therefore suggest a recommended exposure of 0%. The shares weighting in the Capswix All Share is 1.72%. Before I can conclude, can you just take note of the disclaimer? And also, if you would like to submit any questions, you can do so now. I won't be addressing them live, but we will get back to you. And that concludes this webinar. Thank you for listening and enjoy the rest of your day.